You know that feeling? That moment when the news flashes across your screen, some sudden policy shift, maybe a tariff reversal you weren't expecting, you immediately feel that knot in your stomach.
Oh,
That
yeah.
kind of silent dread, thinking about what it's going to do to your investments.
Hmm.
It's like watching the tide suddenly pull way back and you just know your little boat is about to get rocked.
Definitely.
And meanwhile, you can't help wondering if the truly wealthy, the folks with seemingly endless resources, are somehow just sailing serenely through the same storm, their fortunes untouched.
Right.
It feels like a completely different game they're playing, doesn't it?
That feeling of vulnerability, it's completely understandable. When these big, large-scale economic policies shift unexpectedly, the impact on the average investor's portfolio can be really immediate.
Yeah.
And pretty significant.
Yeah.
So it's only natural to question how those at the very highest wealth levels seem to navigate these periods with less apparent damage.
Well, that's exactly what we're plunging into today. This deep dive is titled Trump Tariff Reversal versus Your Portfolio. What the rich know that you don't.
Okay.
We're going to really try and dissect how the wealthy appear to shield their investments when this kind of tariff-induced market chaos erupts, and contrast that, starkly perhaps, with the struggles many everyday investors face.
Right.
So, our exploration today, it's going to be fueled by various sources, analyses of trade policy, detailed looks at investment strategies that people use during volatile times, and also broader perspectives on wealth and inequality dynamics.
We'll be drawing from economic reports, financial news, even some academic research, trying to piece it together.
Think of it as cutting through all the noise, trying to get to the core of what's really going on.
Yeah, and our aim isn't just to, point out the differences, but to really understand the underlying strategies, the knowledge that might be less available, maybe, to the average investor.
Mm.
We want to distill some practical insights, hopefully, things you can actually use to make more informed financial decisions when things feel uncertain.
Because it can feel like you're just being bombarded with information.
Right. Absolutely. So we're committed to pulling out those crucial elements, the things that can really empower your financial thinking.
Okay, so let's dive into a prime example then. The recent implementation of Trump's tariffs back in early April 2025.
Right, I remember that.
We saw that universal 10% tariff brought in, and then almost immediately, a much bigger one, 125% targeting China specifically.
That specific China tariff was huge.
Yeah. And some news outlets even use that phrase Liberation Day,
Mhm.
which, that term carries a lot of weight. But what was the immediate market reaction? What happened right away?
Well, the market response was pretty immediate and quite pronounced. Stock markets took a sharp downturn, globally, really. And major financial institutions like JP Morgan Chase, they reportedly increased their forecasts for a potential recession quite significantly. I think their estimate jumped to around 60% probability if those tariffs were fully implemented.
Wow, 60%.
Yeah. And Goldman Sachs also pointed to a notable tightening of financial conditions overall, which basically just means it got more expensive for businesses and people to borrow money.
Okay, so signaling worry about a slowdown.
Exactly. A slowdown or even a full-blown recession. The fundamental issue was just this sudden spike in uncertainty. Nobody was quite sure about the long-term direction of trade policy.
And this wasn't just a U.S. thing, right? I
Uh,
remember seeing headlines about global markets dropping.
Oh, absolutely correct. The repercussions went way beyond the U.S., Asian markets, European markets that
Yes.
all saw significant drops. It really underscores how interconnected the global economy is and just the widespread worry about these trade moves.
Now, there was also some backtracking, or adjusting maybe. I remember a temporary halt on certain reciprocal tariffs, but not for China. And then the White House clarified that the universal 10% would stay for most countries while talks continued. It felt very fluid, unpredictable.
That's a very accurate way to put it, fluid. This kind of rapid policy shifting, it inherently creates instability. You even had prominent figures like Jamie Dimon at JP Morgan publicly worrying about inflation.
Because tariffs make things more expensive.
Exactly. They tend to increase the cost of imported goods, obviously, but also indirectly domestic goods that compete with them. So you could see broad price increases hitting consumers.
And we saw real reactions from big companies, too. Didn't Delta Airlines adjust some plans?
Yes, Yes, Delta reportedly adjusted their expansion plans for later that year, citing the trade conditions. And Walmart, interestingly, they actually withdrew their quarterly operating income forecast
Pulled their forecast. Why?
to give themselves more flexibility on pricing, basically. It just highlights the level of uncertainty businesses were suddenly dealing with.
Makes sense. Businesses need some predictability.
Precisely. They need it to make sound decisions about investment, production, hiring, all that stuff. Abrupt policy changes just throw a wrench in the works.
Right.
And look, while some argue tariffs can be a strategic negotiating tool, the immediate consequence for investors, like you said at the start, can feel like a real gut punch. Just watching that market volatility spike and your portfolio potentially shrinking.
Okay, so we've painted the picture. Volatile, uncertain landscape thanks to these tariff moves. Now, the big question for this deep dive, how do the wealthy seem to ride out this turbulence? What's their secret sauce, so to speak?
Well, a really fundamental concept to grasp here is something often called wealth defense.
Wealth defense sounds serious.
It is, in a way.
Yeah.
For people with substantial wealth, the primary goal is often just safeguarding what they already have, protecting assets from various threats, maybe higher taxes, maybe significant redistribution policies, market shocks.
Okay.
Their financial strategies are very often built around that core goal of preservation.
Like building a financial fortress around their money.
That's actually a pretty good analogy. And one of the main cornerstones of this fortress is diversification, but often on a scale and using asset classes that are less typical for the average investor.
Okay, so not just stocks and bonds.
Not just stocks and bonds, we're talking about venturing into what are called alternative investments.
All right, give me some examples. What are these alternatives?
Sure. Think about things like direct investments in real estate, private equity.
So buying into private companies.
Exactly. Companies not listed on public stock exchanges. Also hedge funds, big infrastructure projects, even tangible assets like commodities, art, things like that.
Okay.
Now, a crucial feature of these alternatives, and sources like Yield Street highlight this, is they're often low correlation with traditional assets like stocks and bonds.
Low correlation,
Yeah,
meaning they don't necessarily move up or down at the same time as the stock market?
precisely. That's the key. Their performance isn't necessarily tied tightly to the S&P 500's fluctuations, so that can provide a potential buffer during volatile periods like a tariff shock. Some advisors even talk about shifting away from the old 60-40 stock bond model to something different, like a new 50-30-20 formula, where that 20% or even 30% might be allocated to these less correlated alternatives.
So while my stock-heavy portfolio might be taking a nosedive after some tariff news,
Right.
someone with these alternatives mixed in might have a much smoother ride.
That's the underlying idea, yes. It's about not having all your investments reacting to the exact same market forces.
Makes sense.
And beyond just this broad diversification, high net worth investors often maintain a really focused approach on asset allocation, making sure their portfolio mix perfectly aligns with their long-term goals and, importantly, their tolerance for risk.
Okay.
Firms like Jupiter Wealth Management, they consistently emphasize this strategic allocation and also the disciplined practice of regularly rebalancing their portfolios.
Rebalancing. Remind us what that is again.
Yeah, it's basically when you periodically sell some of the assets that have done really well, the winners, and you reinvest that money into the assets that haven't performed as well, the laggards. The goal is to bring your portfolio back to its original target mix.
Gotcha. So it stops you from getting too heavily weighted in one area that just shot up.
Exactly. During volatile times, some asset classes might surge while others fall. Rebalancing helps you maintain discipline, stops you from being overexposed to maybe overvalued assets, and keeps you stuck to your long-term strategy.
Yeah.
Jupiter Wealth also really stresses the critical importance of keeping a long-term perspective. Wealthy investors typically have the financial cushion, the capacity to ride out these short-term market bumps without being forced to make hasty decisions.
Which brings us right to the emotional side of investing, doesn't it? It's so hard not to feel that urge to sell when everything's dropping.
Oh, absolutely. And this is where emotional discipline becomes just paramount. Financial advisors constantly warn against making impulsive, fear-driven decisions during downturns. The wealthy often benefit from having professional advisors who act as a buffer, and also just the financial security to avoid selling low out of panic. Or, on the flip side, chasing short-lived gains based on market hype.
Interesting. So they have built-in circuit breakers for emotion almost.
In a sense, yes. And interestingly, firms like BlackRock suggest that these sharp sell-offs, while definitely unsettling short term,
Hmm.
can actually create opportunities for strategic security selection. They point to powerful long-term trends, mega forces, like artificial intelligence, for example, as potential drivers of returns, even when the broader market is choppy.
So instead of freaking out.
Right. Some are seeing these periods as potential buying opportunities, a chance to pick up high-quality assets at more attractive prices.
Wow. It really sounds like a fundamentally different psychological game being played, while many of us might be hitting the sell button in fear.
Others might be strategically looking to buy. Yes.
That contrast really highlights why everyday investors can often face such challenges during these turbulent times, doesn't it?
It really does. And a huge part of it comes down to behavioral finance, basically. How our own emotions and psychological biases can trip us up and lead us to make, well, less than optimal investment choices.
Okay, let's unpack that a bit more.
Mhm.
Why do so many individual investors tend to struggle and potentially lose out when the market takes these sharp dives?
Well, a primary factor is exactly that emotional reaction we just talked about. When markets drop suddenly and significantly, the fear of losing even more money can just become overwhelming,
Right, the panic.
leading to what's commonly called panic selling. Selling low just to stop the pain. And conversely, during big market run-ups, you get the fear of missing out, right? FOMO.
Oh yeah, FOMO is real.
And that can drive people to pile into assets that might already be overvalued,
Yeah.
buying high. Financial advisors consistently warn against letting either of those emotions dictate your investment moves.
So instead of sticking with our plan, our long-term strategy that we may be carefully put together.
We end up reacting to the short-term noise,
Exactly.
headlines, daily market swings.
Hmm.
Many investors just have this natural tendency to get caught up in the day-to-day chatter, the constant stream of news, and it distracts them from their own overarching strategy.
And that leads to buying high and selling low.
It can, yeah. That detrimental pattern, which is the exact opposite of what you want to achieve as an investor over the long haul.
Whereas wealthier individuals often have these established long-term plans.
Right, and often the guidance of advisors who help them maintain that disciplined perspective, shielding them, somewhat at least, from those emotional pitfalls.
It almost feels like playing with different sets of rules, or maybe just different levels of support and perspective.
That's one way to look at it. The access to advice and perhaps a different psychological framing can make a difference.
Okay, so considering all this, the strategies of the wealthy, the behavioral traps for the rest of us, what are some concrete, smarter financial moves that our listeners can actually consider? How can they better safeguard their portfolios when things get volatile?
Right, well, while you might not have immediate access to, say, private equity deals,
Yeah, probably not.
there are definitely practical strategies you can implement. Regularly rebalancing your portfolio is a crucial one we already mentioned.
Okay, so actually doing the rebalancing.
Yes. Periodically review your asset allocation, that mix of stocks, bonds, maybe other things you hold, and if it's drifted off target, make those adjustments. Bring it back in line with your long-term goals and your personal comfort level with risk.
And diversification, even with more typical investments, still matters a lot.
Hugely important, absolutely.
Yep.
Even if we're not talking hedge funds, diversifying within your available choices across different sectors of the stock market, maybe different types of bonds, maybe even exploring publicly traded REITs, real estate investment trusts, or some commodity ETFs,
Yeah.
that can still significantly help reduce your overall portfolio risk. The core principle is the same. Don't be overly concentrated in any single area that could get slammed by one specific event, like a tariff reversal.
Got it. Spread the risk.
Mhm.
What about keeping that long-term perspective? How do we actually do that when the headlines are screaming market plunge?
Yeah, that's tough. For folks who are earlier in their careers, with a longer time horizon until retirement, it really helps to remember that market downturns can actually be beneficial long term
How so?
because you're essentially buying asset shares in your 401k, for instance, at lower prices. If you possibly can, just keep investing consistently through these periods.
Like dollar cost averaging.
Exactly. Setting up automatic investment contributions, which many financial experts recommend, really helps you stay on track and avoid making those emotionally charged decisions based on short-term swings. You just keep buying month after month.
That makes a lot of sense for younger investors. But what about people closer to retirement,
Mm-hmm.
or maybe already retired? Seeing your nest egg shrink must be terrifying.
It absolutely is. For individuals nearing or actually in retirement, having a buffer, a cushion of more stable and liquid assets like money market accounts or short-term bonds becomes particularly crucial.
So cash on the sidelines.
Essentially,
Yeah.
yes. Many financial planners advise aiming for, say, 6 to 12 months worth of living expenses in these more stable holdings,
Why is that so important then?
because it prevents you from being forced to sell your stocks or other growth assets at a loss during a downturn just to cover your immediate living expenses. You can draw from the stable cushion instead, giving your stocks time to potentially recover.
Ah, okay. That makes perfect sense. A safety net.
Exactly. And a really critical point for everyone, but especially those near retirement, try very hard to avoid making drastic changes to your long-term retirement funds, like your 401k or IRA, based purely on short-term market fear.
Don't ditch your plan.
Don't ditch the long-term plan. Historically, markets have shown a tendency to recover over time. Making rash moves during a downturn often locks in losses.
Okay, so the key actions boil down to stay calm as much as possible, rebalance regularly, diversify within your means, keep that long-term view,
Yeah.
and if you're near or in retirement, make sure you have that safety cushion.
That sums it up pretty well.
That feels, well, it feels much more empowering and actionable than just feeling hopeless when the market goes haywire.
Precisely. It's really about focusing on the elements you can control, right? And understanding that while volatility is just part of investing, there are proactive steps you can take to lessen its potential impact on your financial well-being.
So to kind of wrap up this deep dive,
Yeah.
we've seen how these unpredictable policy shifts, like tariff reversals, can really hit everyday investors hard, creating significant market swings.
Mm-hmm.
But we've also explored how the wealthy often use strategies built around serious diversification, often into those less correlated alternative assets, plus maintaining a long-term mindset and really cultivating that emotional discipline to sidestep panic.
Right. And while the specific tools might differ,
Yeah,
those fundamental principles, diversification, long-term thinking, staying emotionally detached from the daily noise, those are valuable for everyone trying to build and protect their financial future.
absolutely.
And maybe that leads us to a final thought for listeners to ponder. Given these inherent uncertainties, global politics, their connection to markets seems tighter than ever. What are the longer-term strategies you can proactively explore? How can you build greater resilience into your financial future, going beyond just reacting to the latest scary headline?
Hmm. Thinking more proactively, less reactively.
Exactly. How can you actively shape your strategies rather than just feeling like you're being buffeted around by events you can't control?
That's a great question to leave people with. And really, this deep dive has just scratched the surface, hasn't it?
Oh, definitely. There's so much more depth to explore in areas like advanced diversification, different risk management techniques, and that whole fascinating field of behavioral finance we touched on.
So we really encourage listeners to keep exploring. The more you understand these concepts, the more empowered you'll be to make informed decisions and hopefully navigate the inevitable market ups and downs with a bit more confidence.